Hi, this is Claus Vogt for Money and Markets TV. I'm seeing some eerie similarities between what's happening now and what was going on in 2007 and early 2008. Then it was the beginning of the housing slump that disturbed me. Now it's the beginning of the international government debt and funding crisis. Both then and now, the vast majority of my macroeconomic and stock market indicators issued massive warning signs. But just like 3 years ago, the stock market is ignoring them. Back in 2007, Federal Reserve Chairman Ben Bernanke told us the housing crisis was contained. Now, the chief economist of the European Central Bank, Mr. Jürgen Stark, is trying to reassure us in similar terms. Listen to what he just said, and I quote here: "The discussion about restructurings in the Eurozone is based on the totally false assumption that one or another EU member state is insolvent." End of quote. Well, as we all know, 3 EU member states, Greece, Ireland, and Portugal, have already needed bailouts. These countries don't have liquidity problems. They have solvency problems, severe ones at that. And solvency problems don't get cured by injecting additional credit. According to Mr. Stark, a single default by a Euro member country could trigger a banking crisis worse than the one that followed the collapse of Lehman Brothers in September 2008. I certainly agree with him on that point, but he doesn't expect any defaults. And here I disagree. I think European government defaults are just a matter of time. And the market supports my view. In fact, yields on 10-year Greek bonds are well above 20%. That's a strong market signal that default is unavoidable. In theory, there are 6 ways to escape this global debt trap. First, economic growth miracle. Second, major interest rate cuts. Third, bailouts by other governments. Fourth, money printing. Fifth, austerity. And sixth, outright default. In the case of Greece, Portugal, Ireland, and other European countries sitting in the debt trap, only austerity and default are still viable alternatives. They've been trying austerity, but because of their huge debt load, it's not enough to solve the problem, and austerity is very unpopular. So it's only a matter of time before a default becomes the only way out. The situation in the US isn't much better, but the US still has more options left. First of all, the US has a printing press, as Bernanke so famously said 10 years ago. Therefore, inflation is feasible. Second, the US has much more fat available to cut, so severe austerity policies could still lead the way out of this mess. And third, the United States is much more flexible politically and as a society. A return to real market-oriented policies is still possible, accepting short-term hardship to foment a growth miracle later. But even if the US is able to pull itself out of the debt trap, another major banking crisis is still very likely. That's because the global financial system is strongly interconnected. So if a European country defaults, it would affect everyone, US banks included. In fact, the banking sector continues to show conspicuous relative weakness. That's just another reminder of 2007 and 2008. To take advantage of that weakness, consider the ProShares Ultra Short Financials, ticker symbol SKF. That's an inverse ETF that tracks financial sector. If you pick it up at current levels, $57 to $59 a share, set your stop loss at 54 or a bit lower. I'm Claus Vogt for Money and Markets TV. Thanks for watching.